All right. Hello, everyone. Thank you for joining me during those macroeconomics hours. Our plan today to just have an update on the state of the global economy and the potential macroeconomic risks that are out there. As I mentioned before we started recording, I apologize for the cat who is sitting on my desk and who will probably make an appearance every so often. She is, she's been a little bit needy since I've gone away for a week. And let's get started. Here's the bit of the plan. We gave you three articles in the background readings, a couple of them about the world economy and the interest rates. We also gave you a set of articles on the homeland economics report from the Economist, and I don't think I'll be able to get to that today. We'll try to talk more about homeland economics and industrial policy potentially in one of the future sessions, which is an important topic. A lot of governments around the world are trying to reduce the risks to their economies by by creating incentives for firms to produce within the economy, by sort of pursuing industrial policies in general that give preference to some specific sectors. China certainly is some of the inspiration for those approaches, though to my discomfort, it's starting to resemble a little bit the planned economy approach of the former Soviet Union. And we did used to joke that, sort of the planning apparatus is kind of like one of the main enemies of the country. But, sort of we'll try to get through those updates today and maybe save a little bit more of this for the next session. But in any case, macroeconomic indicators. It certainly is starting to look like the economy is cooling down. What we've seen, in terms of the October 2023 employment reports, is that the unemployment rate moved up slightly. So it's continuing to rise. It's rising overall very, very slowly. I think the argument is that even, sort of as long as it's under probably 4.5%, it's still relatively low, right? And sort of this is still something that contributes to the inflation. So this is not necessarily a bad thing. This is what the Fed wants to happen. I think the bit of bad news is that it's a relatively small change, but the labor force participation rate went down by 0.1% in October 2023. And that's generally a concern, right? Sort of, the highest that it's been is about 67% back in 2000. And since then, overall, the labor force participation rate had gone down, which means that we are not using, some of our most important resources terribly well. But the real GDP per capita is still growing. In real terms, the GDP per capita had increased by 2.5%. That's what I sort of like to look at rather than look at the real GDP overall growth rate, right? It's the per capita that matters to me. So this is pretty healthy rate. But at the same time, there is a couple of explanations for why this rate is, why the GDP is growing at such a good rate. But if you look at the non-farm employment month-over-month change in thousands, you can kind of see that the trajectory that we're on is not really looking all that great, right? Sort of the economy is adding overall employment, but in general, it adds a little less on average every single month. And that's I guess for the Fed, sort of right now, it's probably relatively good news, right? But sort of it's also something that they probably want to watch a little more closely, because we're coming to the point where sort of unemployment might become rising fairly faster. Inflation, generally speaking, is looking okayish. If you look at the CPI for all urban consumers, right, sort of this is everything consumed by the urban consumers without any exclusions. The inflation actually went up a little bit. So this is a little bit of a concern. We went down to a rate that was as low as 3.1% in June and 3.4% in September. But what we also see at this point it's really just a couple of things that are contributing to those increases. One of them is the prices of shelter, which is housing, right? That generally, sort of includes, sort of rentals. That can include the imputed value of housing that people own. So that's probably more than 50% of that increase, right? And so there was a little bit of hope that the housing prices, shelter prices will stop growing. They're still increasing. This is still a concern for us. And gasoline contributed a little bit to that. I think that was the second largest contribution. Even though I'm not, potentially, troubled by this all that much. The good news, I think, come from in the core CPI, because the core CPI went down to 4.1%. And if you were with us in the past sessions, we kind of talked about how, hopeful we were, how glad we were to see the inflation go down to 3.1% for all items overall, right? Back in the previous sessions. But core CPI, we did expect to remain elevated. And this is probably still the case. However, what we're seeing is that the true rates are starting to converge, which is probably good news. The federal funds rate has been unchanged since July. The expectation of the markets is that, sort of more than 90% of respondents as of today were saying that they expect that rate to be the same. Just because the inflation overall had been inching back up a little bit. But this is where we're probably going to be. And the question is for how long? And so that's one of the conversations today. So with this in mind, and again, remember to please make sure that you speak up if you have any of the questions. But let's take a look at what is happening to the state of the global economy, right? Okay, and so let's take that quick look. Let me see, I think I did something in here. So the subtitles got turned on, but we'll get to the other slides hopefully easier. So the global economy so far, it's really that, little engine that could, or not so little engine that could. So the global economy growth looks good, but there are a lot of concerns that remain still. So what we're seeing is pretty decent GDP growth throughout the world. The United States is kind of leading the world in that growth, but the interest rates, remember, are still remaining pretty high throughout the world. And so that danger is still there, right? And sort of why is that the case? Why is this a cause of concern for us? Well, first of all, one of the reasons why GDP is doing so well in the US is that consumers apparently are still sitting on quite a bit of savings back from the COVID era. Because remember what happened in 2020, 2021, to an extent 2022, we've had pretty significant government incentives that went out to consumers and went out to companies, and then, in turn, would flow back to the consumers. And consumers were restricted from spending their money because of the stay-at-home orders, because of the inability to travel, so on and so forth, right? So there was a healthy pot of money that they were sitting on. And once most of the restrictions were removed, they started spending like drunken sailors, sometimes literally drunken sailors, and the economy starts getting overheated. So apparently, most of us, based on the statistics, were under the impression that by now consumers more or less spend down their savings. But it turns out not to be the case. There is still probably about $1 trillion in excess savings that is still splashing around the savings accounts, right? And so consumers are still spending despite higher interest rates, partially because they have those savings to rely on, right? And so any of the changes that the Fed is making in the monetary policy, they're not transmitting to the economy quite as clearly. And so the question is, what is going to happen once the excess savings are spent? And when it's going to happen, the expectation is that consumers are going to cut down on the consumption at that point, right? And so your guess probably here when this is going to take place is as good as mine. My guess is probably that this is going to kick in sometime in January, right? Sort of we still have the Christmas shopping season ahead of us. But once we're over that hump, I think some reality is going to to set in for the consumers, and so they'll start cutting down on consumption, which will result in quite a bit of pressure on the GDP growth, right? What we are seeing as well is that bankruptcies are rising, and that's the case both in the US and in Europe. And when we talk about bankruptcies, it's really a mix of things, right? It's your personal bankruptcies, it's your corporate bankruptcies, it's your small business bankruptcies that are increasing. And in many cases, they're starting to increase considerably. And so I'm not going to show those statistics here, perhaps maybe apart from one slide. But if you want to look at the data that's been compiled by ABI, the American Bankruptcy Institute in the United States, and Trading Economics data from Europe, this looks pretty bad, right? For example, in September 23, overall bankruptcy at 12% higher than they were a year ago. And of course, a year ago, the bankruptcies overall, that was still a relatively low number, but still, that's a considerable increase. And if my calculations are correct, so Europe is experiencing something that's fairly similar, maybe a little bit higher. And keep in mind that the European economics is a little weaker than the United States economics macroeconomy. And so, from that perspective, I think, sort of their rate might be approaching as much as a 20% increase in bankruptcies, which is pretty significant, right? Let me see. I think I don't have a slide for those bankruptcies, just those data, but that's what we'll have to stick to. So government budget deficits, and remember the last session, this is what we've talked about, the considerable budget deficits and how much of a concern they are. So they are really adding quite a bit to the growth in the short run, because United States government, basically the, sort of the deficit that we are running in the past 12 months, it's about 7 to 8%. This is incredibly high, right? Sort of this actually sounds to me like the deficits that we were running back during World War II or deficits that we were running during significant recessions, right? So that's not really sustainable. In Europe, in Japan as well, it's probably looking, almost as bad. They're looking probably deficits of around 5% on average. And for Japan, this might become a pretty rude shock at some point, right? Because Japan is one of the most heavily indebted countries. It probably spends around 1/10 of its government budget on paying interest on their debt. And given that they've been borrowing this money, and they've been borrowing, sort of more than 200% of their GDP, right? Sort of, it's an incredible amount of government debt. I think the average, the average blended interest rate that the Japanese government has been paying was about a little under 1%, maybe about 0.8%, 0.9%, something like that. And so once, and even in Japan, the interest rates are rising, right? And so this could be quite a bit of a shock. If the interest rates increase by 1% on average, all of a sudden, once the impact of that starts getting felt, Japan might be spending 20% of their government budget on deficit payments. If the interest rates increase by 2%, so that could be as much as 30% all of a sudden, right? That is a considerable load. And in general, what we're seeing is that the government debt, and this is a mind-boggling statement to me, they are at the highest levels since Napoleonic Wars, right? In the United States, they are primarily talking about the federal government. State governments are actually doing much better than expected, right? Sort of for a couple of reasons. First of all, for the state governments in the US, a number of states, close to the 2/3 of states, have laws that require them to run a balanced budget, either during, sort of a few years, like 3 or 4 years, or the duration of the economic cycle, or even for a given year, right? And so to some degree, that does constrain the growth in the state spending, but because the economy had been doing so well, I think for nearly every single state, the amount of money that the states were collecting was actually much higher than, most of their estimates, above their average estimate, and closing or even exceeding kind of the upper upper prediction, right? So which helps the states, but that party is also going to end at some point, right? So overall, what we are seeing is incredible pressure that is starting to build on consumers and on governments, while inflation still remains fairly high and higher than in the past. And so the question here is, is there anything that could save us? Sort of, is there something that indicates that there is something that's making up for it? And the typical explanation is productivity growth, right? Because we talk about productivity growth as one of those magical things that essentially helps us achieve much higher growth rates, and which enables the economic growth rates not to collapse, essentially. Um, and sort of, I think one of the current explanation for, sort of for the productivity growth rates is that, well, it's starting to inch up a little bit. And what do you think might be one of the technology advancements that might contribute to those higher growth rates? What are your thoughts, folks?
AI.
AI, right? It's a generative artificial intelligence that seems to be our hope, right? Sort of we're placing a lot of hope on that. Governments and economists are placing a lot of hope for that. But personally, I am kind of very skeptical about the possibility of significant generative AI productivity growth. And there is a reason for that. The reason is that it takes a lot of time. And so I actually, as I was putting this together, I remembered that we did talk about one of the concepts related to productivity growth. And that was actually good 3 years ago, but this is still pretty valid. So let me show you this one slide back from 2020 that we've discussed. This is our little look back to the discussion. And so the concept that we talked about was called the productivity J curve. And essentially what this concept is that anytime, let me see if I can actually draw in here. So anytime you have an advancement such as the major new technology, you can expect productivity growth to kind of get jump started. But the way how that jump start actually takes place looks weird. So this is that J curve that we were talking about. Initially, after something is invented, what you do is that you experience lower productivity growth. And only after that, the productivity growth goes up, right? And so what is the reason for that initial lower productivity growth? Well, the idea is that once something has been invented, it just doesn't get translated into better productivity growth instantly, because firms actually have to make significant investments into their processes, products, and business models in order for those things to start impacting the productivity growth considerably. So one of the good examples is that, so the examples that I kind of keep thinking back to is the growth in personal computing and microcomputing that took place in late 1980s and 1990s, right? So this was the time when we started transitioning quite seriously from essentially typewriters to using Microsoft Windows and the Office suite for work in clerical and, well, not so clerical professions, I guess. And it did take quite a bit of time for this to get reflected in the productivity growth, because in order for somebody to transition from a typewriter into a microcomputer, you have to potentially train that person, and the training could be relatively short. It could actually take a lot more time, right? The firm needs to develop a right process for something like that to take place. They have to make purchases, and those purchases initially might actually, having to spend money on those investments might actually force you to take money from other things that you're doing, right? That might be decreasing your productivity growth, and your overall business model needs to get some adjustment done, right? And human capital, sort of grows in leaps and bounds. And so, getting people trained very often requires us to make changes. For microcomputing, think about the changes that they've started making, even starting in elementary school, right? So kids start getting used to the personal computers, to the personal computing devices in the elementary school. They start typing their papers and their reports and to do the research on the internet, sort of in the, primary to middle school as well, right? It does take an incredible amount of time to go from, to incorporate that technology for this more intuitive use, sort of from, primary schooling or secondary schooling and all the way into the college or graduate school, right? It does take time. And there is some hope that generative AI is gonna be a little bit of a faster adjustment, but I'm not really holding my breath right now that it's going to be any different than, for example, was the productivity growth that is associated with handheld devices, right? To me, the handheld devices typically don't get recognized as something that's been incredibly important to the economy. But if you actually think about how widely they're used right now and by a number of professions and jobs, I think that that the handheld devices contributed quite a bit. So that's kind of the story in that, and you can go to those couple of things. The article from Chicago Book Review kind of explains it in pretty easy terms. If you want to see the actual paper part, that was published by the National Bureau of Economic Research, which is still a pretty decent read. You just don't need to read the entirety of it. So I've given that reference as well. And so so that's a bit of our look back that gives me some skepticism about productivity J-curve, right? And the interest rate expectations, here's, sort of some statistics about what's happening in the entire world, right? You can see that, industrialized countries here are represented by United States, by Britain, by Germany, by Japan. So the interest rates are rising everywhere. And the consensus of the profession is that the higher interest rates will be with us for a while, and they probably haven't felt their full impact yet. But at the same time, and let me say this, I'm a little bit torn about this consensus personally, right? So, on the one hand, I do believe that the interest rates are probably going to be higher than they've been historically, because historically they've been at the lows that, for example, the Bank of America in one of their reports actually described as a 5,000-year low, right? We've been pretty close to that 0% interest rate for quite a few years. So interest rates are probably going to be higher, but how much higher are they going to be? So the concern now is that the protective buffers that the economy has built around those interest rates are starting to disappear. And so what do I mean about those protective buffers? Well, think about a government borrowing money, right? Generally speaking, if you're talking about the federal government in the United States, if you're talking about governments of the in the industrialized world, these are long-term government bonds, right? The government issues a mix of bonds of different maturities, but a lot of them could be government bonds that could be 10-year bonds, that could be even 30-year bonds, which reflect a little bit of a premium compared to the 10-year bonds. But the idea here is that once the interest rates increase, it will start getting reflected in the government budgets, but relatively slowly, because the blended rate is going to rise very slowly, just based on the volume of the debt that you're already holding, and the fact that most of that debt is long-term debt. But it will start to happen. If you're looking at the firms, at the corporations, it's going to be the same thing. Firms in the United States have been engaging in leverage quite a bit, right? So during the years when the interest rates are very low, so look at the decade of 2010 to before 2020 kicked in. So corporations generally issued about $4.1 trillion in debt, which is a lot. And at the very same time, they retired about 3.2 trillion in equity for the buyback programs and dividends. And so my question to you is, especially folks who've already taken the finance courses, why were corporations doing that? Does that sound like a smart move? Sort of what's the explanation for this behavior? Anyone? Feel free to unmute yourself.
I would think it's maybe to hedge so that maybe in the future they can borrow money if they need it.
Yeah, it's, part of it is definitely hedging, right? But another big part of it, I think it's really coming back to that concept of leverage, right? What leverage essentially is, if you want to define it in simple ways, it's basically using somebody else's money that you borrow as the base for your operations, right? And what leverage does for you, when the times are really good, it scales up your gains considerably, right? For example, think about your typical bank operating, and the banks are basically the kings and queens of leverage. How do you get leverage? Well, part of it is essentially borrowing from the wholesale market. Part of it is borrowing from your own customers, because when you go to the bank and when you make a deposit at the bank, that's a source of leverage for the bank. They're using your money, and banks in the United States have become exceptionally good at paying next to nothing to their depositors, right? So here are all of those people coming to you and leaving money in the savings account at an interest rate that could be 0.1%, that could be 0.5%. It could be higher at the banks that utilize the kind of like the online savings account model, right? And control their costs this way. But banks basically are getting this money relatively cheap. They charge relatively higher rates on their loans. And what it does is that it really increases your return. When you can compare the return on equity and the return on asset, your return on assets might be relatively low. Your return on assets might be something like 2%, right? Might be even 1%. But if basically the way how you fund operations is that 10% of your money is your equity and 90% of your money is essentially leverage that you're using through consumer deposits and through wholesale borrowing, essentially you're magnifying your return on asset by a factor of 10 times, right? That's considerable. All of a sudden, that 1% return on assets becomes a 10% returns on equity, which looks very, very healthy. And so this party is a wonderful party if the times are good, right? If you are able to make positive returns. But if your returns actually are threatened at any point, then all of a sudden that leverage is going to magnify your losses as well, right? If your return is equal to negative 1%, all of a sudden your return on equity becomes negative 10% and your equity starts getting depleted. And that doesn't have to be the case for the banks only, right? I think banks are a great example because they use leverage so heavily, but the rest of the corporate world had been using leverage, again, like it's been a leverage out leveraging party, right? We've seen that quite a bit. This is the model for the leveraged buyouts, as the name suggests, right? You buy a company, load that company with debt, and if things go well for you, you can make a pretty nice return. If things don't go pretty well for you, then you declare the bankruptcy, and it becomes a game of numbers for the leveraged buyout transactions. It's not fun if you're an employee of the company that goes through that leveraged buyout. That exposes you to quite a bit of risk. So, and consumers are starting to feel the impact of those fixed mortgage rates, right? Because fixed mortgage rates account for about 70% of all mortgages in the United States. That is one financial product that consumers absolutely love, but it turns out that they don't love it so much when your rates are in the 7%, 8% range. I think, sort of if you look at the consumer surveys, most consumers will say, well, sort of maybe about 5.5% is the max that I'm willing to tolerate. That feels fair to me. Everything else, it feels like, I'm leveraging myself a little too much, right? Sort of, it's a little too much to pay in terms of interest expense. If you look at the statistics, and I think this is one of the statistics that comes from one of the Economist article, if you look at your median house in the United States, right, basically, if you're getting a mortgage for 90% of that median house's value, you would actually have to pay about 60% of your median earnings, which is twice as much as it was only a few years ago, right? This is one of the explanations as to why the real estate market is going so slow, right? Sort of that volume had gone down considerably as the interest rates started increasing. And so we're not holding our breath for that, right? Especially given that most consumers are essentially delaying their purchases. They're delaying the process of moving up to the bigger houses because you desperately want to hold on to your mortgage that you've obtained maybe at 30%, right? And sort of that creates, that creates negative pressure on the supply of housing, right? And so you have the combination of negative pressure in demand for housing, negative pressure in supply for housing. And those two things mean that even though the house prices have not fallen so much, in nominal terms, they continue to fall in real terms. And I fear that this process may get accelerated in the next few months. This is going to be very unscientific of me to say, but I try to, sort of speaking about the local environment and those of you who are, sort of from the DuPage County, from the Kane County and the Illinois Will County, I think what I'm seeing, again, in very unscientific ways, is that the short sale rate in the housing market is starting to increase, and there is a lot more of short sales that appear to be taking place, especially in markets that have always been considered to be kind of like marginal markets where people would move to if they wanted to buy more house, but they couldn't pay, for example, Naperville prices, right? So think about houses like St. Charles, like think about the outskirts of St. Charles, where prices have been lower. They're seeing a lot of, at least I'm seeing an uptick in the short sales in those areas, even though places like Naperville don't seem to be quite impacted yet. So I don't know if anybody wants to add to this from your personal experiences and from your local markets. Anyone wants to pitch in?
I will also add that this is anecdotal, but I'm seeing a lot of divorces. So like I need a divorce attorney. And when those people, most of these people are two-income families already. And when they have to sell their house in Naperville, they can't afford to buy two houses in Naperville. They can't stay. So I'm just wondering what's going to happen to these people. Some of them might just stay married because, if they want to keep their kids in their schools.
Yeah, that's right. And I suspect that's actually what's taking place, right? I think, sort of potentially, once people decide that, hey, sort of maybe housing market looks a little more reasonable, right, in terms of interest rates, I think there may even be an uptick in those divorce rates. But that's an interesting point, right? Nadim, Jason, Diana, how about the rest of you? Harshil, Sudha, anything to add here? Anything that you're seeing in your markets, even if it's an anecdotal impression?
I see lots of apartments coming up where we live. I live in Chattanooga, and there used to be a lot of land with wilderness here, and people have brought that down and building huge, huge, tall apartment buildings. I don't know where all that population is coming from, but all of a sudden there's been so many apartments here.
Yeah, and I suspect that probably a part of this explanation is that one of the reasons, one of the reasons why housing is so expensive is that in many states and in many cities, the supply of housing is extremely restricted. For example, if you want to build a high density housing project in Chicago or in Boston, in San Francisco, the process of getting permits is extremely uncertain. Any small neighborhood association can put quite a bit of a stink in there. In Chicago, those companies have to go and kiss their aldermen's, rings. And this, by the way, is probably an explanation of a considerable rate of corruption in Chicago. We are seeing those scandals all of the time. And that's because there are so many arbitrary standards that are controlled by the aldermen. And that presents to you kind of like a naturally poorly designed incentive for the aldermen and for the government employees to engage in corruption, right? If you are able to put a stop on a company's ability to, put up some housing, especially, high density housing, that's where bribes are going to be taking place for sure. And what you're seeing in other states is that building, there is an incentive to build to build housing like apartments or like condos, right? They are cheaper to build per unit. They may be smaller, but they may be more affordable. And companies are switching from building individual houses to building sort of higher density houses, townhomes, condos, apartment complexes. And at the very same time, folks who have bought the houses already, they're sort of sitting on them, right? They're not reselling them because they don't want to lose their low fixed mortgage rate. And so that kind of will push you to seeing a lot more activity in condos and townhouses being listed for sale, because it's the new housing that's coming up for sale. And for new housing, there is an incentive to build more of higher density housing, right? All right, good points. Anything else to add from the, sort of from the rest of the group?
I'm in St. Louis and just in the county area, so outside of the city, and we are seeing the opposite. We still see home prices increasing here and selling pretty rapidly. Things are staying on the market 2 days before they have an offer.
Okay,
but we're
great,
also seeing high density going up too.
Yeah, and markets for real estate are extremely hyper-local, right? So from that perspective, that hyper-locality means that what takes place, say, in downtown Chicago is going to be very different from what takes place in St. Louis, from what takes place in, sort of in the suburbs of Chicago, from what takes place in San Francisco. So yeah, all good points. All right, okay, very good. Just to continue with the, sort of with the pinch that we're starting to feel, right? As interest rates remain, in the same high levels that they have, I am starting to get actually fairly concerned about the banking industry, because this is a picture from one of the congressional reports. And so what this represents is essentially the unrealized gains and losses on securities that are held by FDIC insured banks, right? Depository institutions. And so this is going back into 2023 now. Sort of, it kind of feels like the Silicon Valley Bank problem and the Signature Bank problem and this little cluster of medium-sized banks, which were just below the cutoff for additional reporting and additional, sort of measures taken by the financial regulators. So all of that took place somewhere here, right? Sort of, it's this. I'm trying to draw, but not doing apparently a very good job, right? Sort of, this was the first quarter and the second quarter of the year. But, look at what's happening to the rest of the industry, right? So, sort of, what are those unrealized gains and losses? And I know that those of you who took the money and banking course, you could probably do your own presentation on that because you've spent so much time in there. But it's this idea that when you begin with banks, holding a lot of government debt and a lot of debt in general that they bought at relatively low rates, right? For example, you've been buying whatever, 10-year government bonds that paid you 2.5%. Once the interest rates start rising, the value of the securities that you hold starts going down, and it goes down faster if these are the securities that have a long-term maturity, right? Because the market starts basically discounting them based on the new interest rates and the market expectations for the interest rates going into the future. And so what happens is that as the value of the securities that you hold already, something that you bought for whatever, you may have bought something, for $100, and the value of that security went down to $80. Our current accounting rules for banks do not force the banks. Harshil, I think you are, sorry, I can't hear you quite well. Did you want to ask a question? Okay, may have been possibly accidental unmuting, right? Okay, so gosh, what was I talking about? So, the banks that sit on their securities are sitting on potential losses. And the reason why we call them unrealized losses is that, as long as you continue holding the security, you're still going to collect the money that you basically, roughly paid for that security, right? But it also means that while your profitability for the years that you hold it will be impacted, in the very end, you're still going to collect your money back, because these are typically high quality securities, like the nearly interest risk-free securities issued by the US government, right? But the current accounting rules basically say, well, if you expect to hold the security to maturity, you don't have to reflect it in your financial statements. And so this is what the orange bars are reflecting. These are held to maturity securities. And so you can see that they generally account for, a little more, than 50-60% of the bank's holdings, right? However, if you mark something as available for sale, meaning that you're interested in selling the security should the right offer come along, that basically means that you have to start recognizing their value pretty quickly, right? You have to reflect that in the financial statements. You have to mark them down to the market, which means that potentially you could be taking losses if your assets start, if your assets are going down. That basically means that the bank owner's equity is going down. And if the assets go down too much, the bank is kind of forced to do one of the two things. Either it has to raise additional capital from its owners, or sell additional equity to new owners, or it has to declare bankruptcy, right? Because the bank is no longer solvent. And while the Fed had created a couple of facilities to deal with that in the short term, when the problem of Silicon Valley Bank started rising, the concern still remains. The banks are sitting on a lot of unrealized losses. And the question is, how long is this going to last? And that part is somewhat unclear to this point, right? What we are seeing is that it puts a lot of pressure on community banks, because community banks are typically considered to be, these are your small local banks. They are considered to be more exposed to the local markets. And they're often considered by the depositors to be a larger risk than, for example, a behemoth like the Bank of America or Citibank. And what happens in those cases is that people often take their money from community banks to those mega money market banks. And community banks, if the money is flowing out from those community banks, they're going to be forced to sell their securities right now. And so this unrealized loss is going to become a real loss, and that could potentially end up in a bankruptcy or in a resolution or in the need to raise more capital. It could be pretty ugly. But at some point, this can become a problem for the large banks as well, right? And if consumers start believing that there might be concerns about their solvency, that might not work out terribly well even for the larger banks. And so to me, this still remains kind of a large concern in the economy, and something that's relatively unknown to us, how this is going to crumble, right? We don't know how that cookie is going to look like, 6 months from now or 12 months from now. But at the very same time, all of those things, that means that the pressure is building up, and this is the pressure on the interest rates and on the economic growth in general. And so interest rates won't be able to stay that long for a very long time, potentially, right? They're probably not going to be at the 5.25, 5.5% rate, which is the current rate that we have in the United States. Similar rate is in the United Kingdom. Once all of those buffers start going away, economic growth will start getting impacted negatively, and by quite a bit. There could be potential additional banking failures, which will put a lot of pressure on the financial system, on the financial regulators to respond. And of course, the Fed is the financial regulator for the banking industry, right? So at some point, despite the consensus that the higher rates are going to be with us for a while, my sense is that those pressures of consumers stopping to spend money, of higher rates on corporate debt, and the impact that leverage has on corporate performance and potential quick failure of a lot of corporations, and the danger to the banking industry, and the pressure from the government, which, if you have to pay much higher interest rates for the government debt, that could put an incredible amount of pressure on the legislatures, on the executive branch, and some of that pressure will probably get translated to the central banks, no matter how independent they are. So the rates, I suspect, once those pressures start manifesting themselves, my sense is that the interest rates will probably start going down fairly quickly. They'll end up then somewhere in a state they're going to be higher than they were, for the past 10 years. But I don't know how much of a difference there's going to be, right? We were close to a 0% interest rate for many years. And so, could we come back to something like 1%, 1.5%, 2%? I think that's quite a possibility, right? And so, I'm not a betting person, so I won't, bet you how long this will take. But, at least that's my sense, that the, the consensus that we are going to have much higher interest rates for a long time. I don't think that this consensus will necessarily, stay with the profession for long, right? Because of those significant pressures that we have, not just in the United States, but in the rest of the industrialized world, and to an extent in a lot of smaller emerging economies, including China. And China has not been doing well economically, including Russia, which has had its challenges. The BRICS countries. So we'll see how this cookie crumbles. So it's going to be interesting how this will work out. But I think the big point of today's presentation is to recognize those significant pressures on consumption, on the financial industry, on the government, and on the corporations, and to recognize that this pressure could unravel fairly quickly. All right, that's really it for me for today. So let me share my screen. And I've seen a few items that are popping up in the chat. So any of the questions that you want to voice out, folks?
Okay, I have a question.
Sure.
Does anybody, I don't know what the chatter is, but with AI being so like the big, the next new thing, is anybody looking at the fact that the result of AI is supposed to kind of eliminate some jobs? So it's like we might be digging our own graves for things like cybersecurity, like IT help desk, some of these, and these fairly high paying jobs. So if those kind of go away, is anybody talking about what the impact economically could be?
Yeah, I think there is a lot of it, right? And so if you think back to, I love that expression that Larry DeBrock had, and you probably had heard it. He calls this "computer ate my job" sort of string of literature in economics. And there is a string of literature and something like that. So I think the overall consensus is that there are concerns about how exactly this is going to play out. But I think, in the grand scheme of things, the impact is probably going to be very similar to the impact of large innovations that we've seen in the past, right? So, I don't want to take us back to the Luddite movement in the UK back in, gosh, when was it? Was it 18th century or 19th century, when there was a whole movement of people who were concerned about industrialization, and they were going around, sort of banging on their pots and pans, protesting industrialization, saying, well, this is all going to take away our jobs. Sort of the outcome of that is that some types of jobs actually disappeared, that the jobs that were created were actually better paying jobs that lifted up, sort of the majority of the population that was very poor into the middle class territory, right? Same thing took place with nearly any large invention, right? When we had, when the car production was industrialized in 1920s by the Ford company. Same story, right? Sort of a whole bunch of professions basically disappeared, like buggy drivers. But sort of there is a lot less horses out there than there used to be, and so people who took care of them. So that's not really a profession anymore, unless you're doing something for leisure and sports, right? But overall, the jobs that were created were better jobs, better paying jobs, and more complex jobs. And I think, sort of my own sense is that this is going to play out in the very same way, right? What we're seeing is that some jobs are disappearing, like, some of the coding jobs, which are not necessarily terribly fun and exciting, right? If you were doing kind of like basic repetitive tasks, if some of that repetition could be taken away from AI, but some of those jobs are going to transition into what I could call AI checkers, making sure that AI is doing what it's supposed to do, fixing up AI mistakes, kind of contributing to the better learning models for AI. I think that's actually quite possible that that's a higher level of skills. That's probably going to be higher pay for those folks, right? I mean, at least, what I'm seeing right now is that the jobs that are coming out in large corporations that are concentrated around the response to AI, the pay right now is incredibly high, right? We're seeing 2, sometimes 3 times, 4 times the typical salary of a mid-tier person in that corporation. So I think from that perspective, some people will make out really, really well with something like that. Some people will see their jobs disappear. And I think this is going to be something for the government potentially and for the industry to figure out how to respond to. Because we can talk about macro level factors until we are blue in the face. But really what it comes down to is that if there is a significant percentage of people who are being misplaced and whose skills are basically obsolete, how is the government going to respond to their training programs, with other programs to somehow help those folks maintain their lifestyle and their income? And my own sense is, sort of having worked with some of the government, unemployment agencies and training agencies in my past life, I've worked for 2-year colleges, and a lot of our programs basically were meeting the needs of some of the unemployment training programs because they were relatively short. One of the schools that was in my portfolio was literally a truck driving school, right? And these are fun and these are rough in their own ways. I remember we had those, sort of trucks that we had to retrofit, sort of so that we could fit 1 instructor and 4 students in the cabin, right? Who could learn how to drive trucks and get their CDL licenses. But once they were done, those folks, often went into jobs that paid them $50,000, $60,000, sometimes $70,000. And this is in a state of Mississippi, right? Where, your pay is not terribly high. And so it's going to be most likely the response of the government to those folks who are displaced by AI that will be my largest concern, because my own sense is that it probably hasn't been done terribly well in the past. It's been done in fairly inefficient way. But again, this is a very anecdotal perception from where I used to sit, right?
Right. Interesting.
So we'll see, right? We'll see. So I think generally speaking, AI on average is going to improve our well-being. But for a significant subset of folks, they'll have to figure out how to respond to the idea of retraining and helping them bring back their productive economic lives to where they used to be. All right. Harshil, did you have a question? Feel free to unmute yourself. I'm seeing something about the difference in risk between credit unions and local banks. So my own sense is that credit unions, and so credit union statistics often don't make it into the FDIC statistics because credit unions are regulated by their own agency, NCUA, the National Credit Union Administration. And so, but at the very same time, I think they're probably fairly similar to the community banks. I think they can afford to take a bit of a longer time horizon because they're not as much at the pressure of the market in terms of their valuations, right? So if you're a publicly traded bank, if you have to decrease your valuation, right, sort of the markets can get very concerned, sort of the price of your stock can go down fairly quickly. That may force you to unwind some of your holdings and so on and so forth. So I think there is less pressure like that on credit unions just because they're owned by their account holders, right? But we'll have to see. Sort of this is also one part of the financial industry where I think the data is a little bit more opaque, for lack of a better term, and where we don't see the impact quite as well as they see the impact based on the research and the data from FDIC insured banks. All right, folks, any other thoughts or questions or additions to the discussion?
As always, this session had been extremely helpful. Thank you so much, Professor.
All right, well, thanks very much for the kind words, Sudha. Any ideas for the future discussion? So as I mentioned, one of the things that Hani and I are thinking about is potentially talking more about, sort of this concept of homeland economics and industrial policy. So that's one of the things that's on the list. Another thing that I have on the list is potentially looking at the local governments, meaning, sort of state and municipal governments a little bit more and seeing sort of what is happening to this sector, because the past couple of years have been very good years for the state and local governments in general. But again, is this a party that is going to last, right? Sort of that's a concern. And how will the performance of the federal government's accounts impact the local governments in the future? So that's kind of like another idea. Anything else that we should consider?
I think it's premature, but I think, what's going on internationally might have impacts. These things are sudden and jarring, like what's happening in the Middle East. So if there's anything else, these things trigger other things.
Mm-hmm.
So
I think they do. That's absolutely the case. These are it's really sort of the amount of the conflict that is taking place globally. Sort of we've seen that how the sort of the war in Ukraine had impacted the international economies, right? The world economies. And sort of it's going to be interesting to see what is going to be taking place. Sort of what's the Middle East conflict going to add to that, and potentially sort of any conflict around Taiwan, right? So which is a huge concern at this point. Even though sort of I think the temperature had been dialed down considerably compared to what was the case about a year ago. So Harshil is suggesting some of the life-changing innovations. So things like the obesity drugs, right? And sort of it's really an interesting discussion, right? Because the anti-obesity drugs have been changing. I think they're changing healthcare as we know it, right? It's one of those innovations that seems to be also having quite a potential to increase the healthcare costs, given that the drugs are patented, right? Sort of they're going to be staying patented for a while, but at the other time, sort of the cost benefit analysis between those, I think sort of the benefits are absolutely incredible, especially given one of the recent reports that came out that talked about the mortality for folks of heart disease and obesity, right? And the reduction in there appears to be kind of like equivalent to the reductions that statins had in mortality, and state and sort of reduction in mortality had been probably one of the biggest healthcare innovations of the past 50 years, right? And so that's also a great idea. Thank you.
I work in that space. I work in med tech and particularly obesity surgery. One of the impacts that I think will be interesting, Harshal just put in a comment in the chat that's relevant, but I think the impact on our fast food and the food whole sector is going to be interesting with those drugs. Grocery stores, restaurants, all of the above, not just healthcare.
That really sounds like a very good idea, right? Because, I can absolutely see how people have to respond. And I've seen some statements from the large consumer products companies that are starting to address that and saying, oh, we're coming out with snacks that will meet the needs of folks who are taking those medications. And my initial reaction to that was, what are you talking about? But then, sort of the wheels eventually started turning. I'm like, oh, I can see how that's going to work out, right? Yeah, absolutely. This seems like a very, very interesting item to talk about. Thank you.
So to answer Harshal's question, the drugs are, depends on your insurance company and what you're getting to, having to pay, but they run about $12,000 a year if you're not getting, a discount or a coupon. And oftentimes you can get bariatric surgery for that same amount. So that would be a one-time, you'd pay that once, have the surgery done. The data correlates very closely with what the drugs are giving you, and you don't have to take the drugs for the rest of your life. But hard calculus for a lot of people.
Yeah, that's for sure. And interestingly enough, there was an article that just recently came out that I've seen that talked about the actual cost to the insurers, because essentially what the authors of the article they took the data on reimbursements, right, and tried to figure out sort of even if the drug is priced at something like $1,500, $1,200, sort of this is kind of like the list price of the, sort of whatever is the name for it, the average wholesale price. And I remember, from many years ago, so somebody made a joke that this abbreviation for that average wholesale price, was something like ain't what's being paid, right? So the wholesale price is not necessarily what people are paying, but it looks like in general, sort of those medications, what the insurance companies are paying for them, if you take into account the rebates and other incentives, are something to the tune of about $200 to maybe $250 per month. And sort of that becomes, at that point, a much better value proposition than the drug that is being sold at $1,500 per month, and that has to be taken for the rest of your life, right? Yeah. Okay. All right. Excellent. Well, thank you. Those are really, really good ideas, folks. I really appreciate it. I really appreciate your joining this session. So hope to see you soon. I'll post this on our YouTube channel. We're trying to put the videos on the YouTube channel these days. We'll see how that goes. I'll post the the presentation notes, and we'll go from here. And hope you have the great rest of your day, and talk to you soon. Bye all.
Thank you. Nice to see you again.
Good to see you too.
Have a great day.
Bye-bye now.